Like everything our government does, navigating superannuation, the age pension, retirement, all that stuff's a complex bloody minefield. So today we're going to go through some case studies and hopefully give you a bit of clarity. Should be a good one. G'day, I'm Phil. Welcome to the Wealth Lab podcast for this week. Probably notice my offsider looks a little bit different, and no, Scott has not gotten better looking. I'm going to introduce Dan, who's our newest advisor. Dan, welcome.
Thank you. Big shoes to fill.
Yeah, that's it, mate. So, look, Dan has been working away over the last 12 months doing his professional year, which is what you need to do to become an advisor these days. He's done all of that and he's ready to go. So we're going to let him loose. But Scott is currently away over in Japan, hopefully having a great holiday.
Living the good life, for sure.
Living the good life.
Yeah.
Look, today I thought, we've been asking for feedback on topics we should cover. And if you go back, if you've been listening for long enough, you'll have seen us touch on a lot of the topics that we'll talk about today at a higher level. We've done a lot of podcasts talking about applying for the age pension and what that kind of looks like and how the assessment works, the assets test, the income test, how it interacts with superannuation, as well as things to consider coming into retirement. One of those being, if you've got investment properties to sell and how does that all work and some of those sort of things. So a lot of the requests we've gotten off the back of those topics has been actually, can we show some worked case studies? Can we show some examples of how these things actually apply? So, we've covered the limits, we've covered how things work, but we haven't really shown how that applies to a couple or to an individual and how that assessment actually works. So today we're going to get into a bit of the nitty gritty of that sort of stuff. Look, some of it's a bit dry, but if you're coming up to retirement, it's going to be valuable information. So yeah, jump in and have a look. As always, hit us with any questions in the comments.
Hi there, just jumping in. Thanks so much for watching this video. I've got Jordan, my client liaison here. He's the one you're going to speak to if you've got some questions about if we can help you. Click in the description below. We've got the booking link as well as a score app that'll help you understand where you're at. No obligation. Jordan's much more friendly than we are. He's got some great answers to some of your questions. Look forward to seeing you soon. Thanks. Back to the video.
Dan, I might let you go first, mate. What have you got for us?
All right. Picked a pretty common scenario for clients coming into retirement who come to us with an investment property. I think everybody's inkling is if you're going to get rid of that investment property, they just want to get rid of it straight away, take the earnings from it and, live off those earnings essentially. I've built a little bit of a scenario here. It's taken from a current client scenario. And it basically shows how if you delay the sale of that investment property into the first year of your retirement, how that can drastically change or affect the capital gains tax that you'll pay.
Yeah, awesome. So this is a really common scenario we come across. Dan, I don't know what your experience has been so far, mate, but I generally find like a lot of retirees, they get to retirement, they got the investment properties, they don't want the headaches of managing tenants and that sort of thing, and they're usually looking at bailing out. Is that what you found as well?
Yeah, that's right. They just want to get rid of the bills, the tenants, all of those problems, get the money out and get an income generating with no fuss.
Yeah, perfect. And look, if you've watched any of our previous episodes, you'll have seen us touch on this and some of the strategies that can help with your capital gains tax and just good planning. Now, none of what Dan's about to go through is going to cover off on, the actual expectations of the property market and whether you should hold because property is going to go up or down or, left or right or whatever it's going to do. My crystal ball's no better than yours, but, we're going to just touch on some of the practical, I suppose, planning, tax aspects, super aspects and those sort of things and some of the more tangible stuff that we can plan for, not the unknowns of where the market's going to go. But anyway, I'll shut up now and let you talk, mate.
Yeah, the scenario is really built for if the client is locked into selling the property, just how delaying that, even by a few months, because it could be the difference in financial years, how that can make a big difference in their capital gain. The first point I'll hit is, I think the big mistake people think about capital gains tax is its own standalone thing. There's nothing that you can do to affect it. But really, the capital gain or the effective capital gain is added to your taxable income for that year. That really demonstrates that if you delay that capital gain into a year where you have a lower taxable income, so that the capital gain that you pay will be lower. For example, somebody who earns $140,000 in a year, if they sell a property with a large capital gain, the capital gains tax they pay in that year will be drastically different than if they sold it in a year where they had zero taxable income. I've got a bit of a scenario here. We have person one and person two, both of them with under $500,000 super balances. One earns 150K, the other earns 95. So just a couple, they own this investment property 50-50, just to make it simple.
Yep, beautiful. Pretty common scenario anyway.
Yeah, that's right, exactly. Nearly everybody. So if they were to sell that property in their last year of working, so person one had an income of 150 grand, person two had 95 grand already. Any capital gain that they add on to that, taxable income, so they're likely to jump up a tax bracket. And I've got some numbers here to demonstrate around that. So person one, their taxable income would go from 150,000 to 275,000, presuming $125,000 gain each is added to their taxable income.
Yeah, so you're going from like a 30% tax bracket to a 47% or something with Medicare.
Exactly right.
Yeah, big difference.
Yeah, so essentially that person, instead of paying 36 grand tax on the 150, they'd be paying $89,000 tax on that 275,000. So it's a huge difference.
Nice tax bill.
Yeah, that's right. Between the two of them, they're looking at about $98,000 in capital gains if they sold it that first year. So this is no super contributions, no nothing. They've just sold the property, $98,000 added to their tax bill. So from the 250, they've sold the property for 500, 250 effective gain. They're going to lose 98,000.
Nice gift to the government.
It is. Yeah. So if they delayed that into the following year, let's say we add it to the next year when they've retired, they're going to have zero income. They're going to add 150 grand to their taxable income from the gain each, which means each of them will pay 36,800 or thereabouts in tax if they sold it in that next year, which is a combined 73,000 in tax payable, which means they've reduced their tax by $25,000 just by delaying it from their last year of working into their first year of retirement.
Yeah, there could just be the difference between selling in June and selling in July.
That's exactly right. It could be a couple weeks difference. It's just wildly different. I've also run the numbers with catch-up contributions. So in that example just there, it was still like a large cap. So you're still paying $73,000 of that $250,000. But if we allow for catch-up contributions, we could get that effective tax payable down to like $11,000.
So what are catch-up contributions, Dan?
Your balance has to be under 500,000. That's the first hurdle. Then you can essentially catch up the last 5 years of unused concessional contributions. So for this year, it goes back to the 2021 financial year. So you can catch up those 5 years as well as use your $30,000 from this year. You'd be silly to throw it away, right? Especially in this kind of scenario where you got such a large, you're realizing such a large gain, you might as well use it for sure.
Yeah, so I suppose to go a bit deeper into that, what Dan's talking about is every year you've got $30,000 that can go into your superannuation as a concessional contribution. And when I talk about concessional contributions, it effectively means anything you've had a tax deduction claimed on. So if you think about that, any employer contributions you're getting, so you go to work and you get your standard superannuation guarantee contributions, 12% of your salary, that is a concessional contribution. So, what'd you use there? Someone earning 100 grand a year as an example, was it? Yep. So, they would have, if they're not doing any salary sacrifice, they've got about 12 grand of concessional contributions going in from their employer.
Yep.
So you've got the difference between that 12 grand and the 30 grand limit that you can still put in. And if you have not been doing that each year, then you can use this catch up. So you could go back the last 5 years, and anywhere where you've got a gap between what went in and that 30,000 limit, you can catch that back up. Look, I see a lot of people get this wrong. There are some intricacies to it. If we're working with you, we'll do the math and we'll let you know what makes sense. But yeah, that's sort of the rules that Dan's talking about there. And we've spoken about this briefly before, but never really actually gone into doing an in-depth case study and just showing the power of what that means. But, going from, 93 grand tax if you sell in the year that, your final year at work and no contributions down to, what'd you say, 11 grand or something?
Yep.
Yeah, pretty significant saving for a bit of smart planning, I reckon.
Yeah, I think even it shows another advantage of delaying it that extra year because you get access to that another $30,000 of contributions that you can use, right? So. Yeah,
exactly right. And you've probably had no employer contributions that year if you haven't been working. Yep. So, yeah, look, that's a great one. We do actually a lot of this kind of stuff. There's some great strategies there, and we do get a lot of clients come to us with investment properties coming into retirement. So it's a real neat tool. It doesn't just have to be investment properties though. It could be a share portfolio that you need to start selling down, or kind of any other asset that's going to trigger capital gains tax. So quite often, and I can think of a few cases of clients that I've worked with recently where that's actually been the difference between them deciding to retire and not deciding to retire, because they were just scared about the fact they had to realise properties to actually have enough liquid assets to live off, but they didn't want to pay the tax bill. So we've had a few really good cases there where we've been able to significantly decrease that tax bill, and it's been the difference between people hanging in at work and actually going, right, actually I can sell this property and get out. So if you're in that situation, it's definitely well worth having a chat, I think.
We've also, it's something that you can't reverse either. So we've seen people who've come to us maybe slightly too late who have sold it in their last year of working, or they're trying to make contributions, but they sold it last financial year, things like that. And it's almost better to come see before you do it, just to make sure you're making the right decision, I guess. Yeah,
for sure. Yep. Awesome. All right, good one, Dennis. Thanks, mate. This one's been requested a lot. So I've done a bit of a case study on an age pension application. Now, you'll notice he's obviously out to make a good impression. His presentation's nice and pretty. I'm a much better financial planner than I am graphic designer. So if you've been watching long enough, you know I love a good ugly spreadsheet, and that's what I've got today. But I'll talk through it and explain what it all means. But really, we're just going to walk through a case study for a couple, walk through their assets, the income that they need, and how that's going to work from a superannuation and age pension perspective. I'll talk through what's going on so it'll all make sense as we go. So if you think about here, we have a couple. They are both aged 67 and they're ready to retire. They've got a home worth about $1 million. They've got motor vehicles worth about 50, contents worth 20. Now, a couple of notes on motor vehicles and contents, and the caravan for that matter. When you're doing an age pension application and you're giving values for your assets, because they will ask for values of your assets, you're using fire sale value. So, you know, contents 20 grand. Sure, that might seem low because your insurance is probably 100 grand or more. But when we're thinking about the value of the contents, we are thinking about, we threw it all on the front lawn and we sold it to the first person that came along. So fire sale value. Cars, whatever your reasonable red book value is, same for your caravan, that sort of thing. So they've got $1 million home, 50 grand in cars, $50,000 caravan, 20 grand in contents. Husband's got 400,000 in super, wife's got 200,000 in super. They've got a joint bank account with $50,000 and they've got a little $20,000 share portfolio. When you apply for the pension, Centrelink are going to run 2 tests to determine what you are eligible for. And I've done this in the context of a couple, so these limits are in relation to a couple that are homeowners. But the principles apply for singles, non-homeowners, all that sort of stuff. The same principles apply, it's just that the limits are different. So, you know, if you jump on and just Google age pension assets test, income test, you can find those rates really easily. Obviously, I can't run a scenario for every, you know, different sort of setup that everyone's got, but this will give you a good example. The principles remain the same. So in the case of a couple that are homeowners, they're going to look at your assets and they're going to look at everything you own. So as I've included here, any motor vehicles, contents, caravans, boats, jet skis, whatever you've got, your tool collection in the shed, all that sort of stuff. They're also going to look at any accessible financial assets. So superannuation, money in the bank, shares, managed funds, any investments, investment properties, all of that sort of stuff. And they're also going to look at any income that you're earning from anywhere. So if you're still working part-time, or maybe you've got rental income coming in, or you know, any income that you've got coming from anywhere forms part of your assessment as well. And they run 2 tests to work out what you're going to be eligible for. The first of those is the assets test. And to get a full pension for a couple, your combined assets need to be under $481,500. This is as of January 2026. And to receive a part pension, your combined assets need to be under $1,074,000. When they are looking at your assets, your home is excluded from the assets test. Now, there are certain instances where it could be included, but for the scope of this podcast, we're going to leave that out. And, you know, because 99% of your home will be an excluded asset. So it will not be counted in either of these limits. So when we're considering your assets for age pension assessment, in the case of our couple here, we're talking about the vehicles, the contents, the caravan, super balances, bank and shares. So if we exclude the home, we've got a total of $790,000 of accessible assets for the age pension. And so Centrelink will look at the total assets you've got. They will take off this lower limit and they will take $3 per 1,000. So for every $1,000 that you are over this lower limit, they'll take $3 of age pension off you per fortnight. So that's the first test they're going to run. Then they're going to run a second test, which is called the income test, which is going to look at any income that you're receiving from any source, and they will use that to reduce how much pension you're eligible for. So for a couple, you can have up to $380 per fortnight before you lose any pension. Anything above that, they will start to reduce your pension, and for a couple, it's 25 cents in the dollar each, so 50 cents in the dollar, for everything you are over this $380,000 until you get to the $3,934, at which point you get cut off altogether, or your pension reduces to nil. When they're assessing your income, it's pretty simple in the case of, you know, rental income or employment income or whatever else. It literally is just whatever you've earned. You earn $1,000 a fortnight, $1,000 a fortnight counts towards your pension. Now, there is a work bonus that reduces assessable income from employment. I'm probably not going to cover that here today, or we're just going to get far too deep into the weeds, but there is the ability to just continue doing some work in retirement and have that income offset, not included in the pension test. So if that's you, look, give us a call, hit the link and book in, and we can have a chat about how that would apply in your circumstance. But for most people, any income you got coming in, that counts towards the income test. Where it comes to your superannuation, any cash in the bank, any shares, any financial investments, this is where the income test gets a little bit trickier. And this has caused a bit of a stir in the comments section in previous podcasts, so we'll see if we can shed a bit of light on it all for you. But essentially, what they do is they actually don't care how much income you are actually receiving from any of these investments. What they do is they look at the balance and they apply what's called the deeming rates. And the deeming rates are an assumed rate of return that you're receiving on these investments. So just for argument's sake, your super might be invested and you might be getting a 6% return for argument's sake. So, 6% on the wife's super here of $200,000, that's like $12,000 a year. They're not going to include $12,000 on your income test. What they're going to do is they're going to apply the deeming rates as an assumed rate of return. So for a couple, the first $106,200 of your combined financial assets are going to be assumed that you're earning 0.75% interest on it. So that's about $797 a year. For everything over that first $106,000, you're going to be assumed that you're earning 2.75% on that. So in our example here, where we've got, $670,000 in assessable financial assets, the total assessable income off that from Centrelink's perspective is $16,301 or $627 a fortnight. If you had some employment income, that would add to that. For argument's sake, you earned $100,000 a year. That jumps it up to $4,473. But if we just assume in this case, both the couple are retired, so we've just got the deeming rates to worry about, and that's it. Centrelink looks at both of those tests, both the assets test and the income test, and whichever one of those gives you the worst outcome is the one that they're going to apply to your scenario. So if we look over here, the full age pension for a couple is $1,777 per fortnight. That includes the supplements and everything. That's the full amount. Under the assets test, they're going to have that amount reduced by $925.50 in this particular scenario. Under the income test, they would have it reduced by $123.48 under this scenario. So no prizes for guessing which test Centrelink are going to apply. They're going to apply the assets test in this case, meaning that this couple are going to receive $852 a fortnight in age pension. What do you reckon, Dan?
Yeah, those deeming rates are so low that quite often it's going to be the assets test that pushes people over, right? If they're not working, or if they don't have an external income, it's really that assets test. Really.
Yeah. I'd say the vast majority of people we speak to, or would be north of 95%, would be asset tested for sure. And the deeming rates is actually a cool one. This is one of the rare cases where Centrelink's rules kind of work in your favour because you should be earning more than 2.75% on your investments. If you're not, then you probably need to be talking to someone about that.
Even in a bank account, if you're getting 4 or whatever you're getting,
exactly right. So, if you're earning 6, 7, 8, 9, 10%, whatever you're earning on your investments, they're still only assessing the top end of it at that 2.75. So it's a free hit. So that's how it works. So if we think about this particular couple, just say that they need $76,505 a year to live off. And I know that probably sounds like a bit of a random amount to have plucked out of the sky. And I didn't pluck it out of the sky. That's why it's a random amount. You'll have heard me speak before about the ASFA retirement standard. So the Australian Superannuation Funds Association, whatever they're called, but they go and they survey retirees every quarter and they give us real world data on what people spend in retirement. At the moment, for a comfortable retirement, your average couple are spending just over $76,500 a year. That's where that number's come from. So if this couple are the average retirees looking for a comfortable retirement, that's how much they're going to need every year to live off. They're going to get $852 a year from the age pension. And the remainder, we can then just go and draw from their super. So, there's a million ways you can do this, but typically what we would see is people go to what's called an account-based pension, which is just shifting your superannuation from where it is now into an account that pays you an income stream. So in this scenario, each member of the couple could be drawing about $1,050 a fortnight from their super, plus the $852 from the pension, and that's giving them that $2,943 a fortnight that they need to meet the comfortable retirement standard. I realise I've been talking for a long time and this is pretty dry, but this is something a lot of people have asked to see, so hopefully this is all making a bit of sense. But I just want to touch on one last little complicating factor here, And what I get asked really, really often, and what did cause quite a stir in the comments on previous episodes, we've talked about stuff along these lines. A question I'll often get asked is, hang on a second, if I'm drawing $1,050 or we're drawing between us, $2,100 a fortnight from our superannuation, is that not now going to fall under the income test for the age pension and actually mean that we lose it? The answer is no. This income is completely ignored by Centrelink for income test purposes. It doesn't exist. This is the thing people often get hung up on, but I want to explain why it doesn't exist. Because if you think about it, although it's called an income stream and they're called income payments, it's not actually income. When you are drawing a fortnightly income stream from your superannuation, it's not income. It's a return of capital. It's the same as if you had $400,000 sitting in your bank account and you went and made a withdrawal for $1,050. That's not income. That's just withdrawing on your own money. So that's why it's not included in the income test. It's purely and simply the deeming rates will get applied. So this will get ignored altogether. It doesn't impact. Make sense?
Yeah, I mean, that's a great explanation. It's a very nice spreadsheet too. I quite like it. Yeah.
Thanks, mate.
Very good.
Yeah, it's about that is well and truly the extent of my spreadsheet abilities right there for you. So look, I feel like I've been waffling on for a fair bit there, and we've done about 25 minutes on some fairly dry information. But look, hopefully that gives you all a bit more context around how this stuff actually applies in a real world example. This is like Dan's example. That's a real world client scenario that we've been working on, and mine's a real world assessment of how things would go if you applied in that scenario to Centrelink. If you want to know more about how that applies to you and what we can do to maybe improve your assessment for Centrelink purposes and all that sort of stuff, look, there is stuff that can be done depending on your scenario and what's going on. There are different assets that are treated differently, different types of income streams that are treated differently. Maybe you're lucky and you've got a younger spouse and there's some really cool stuff we can do. So, it's always worthwhile having a chat before any of these massive financial decisions, like, Dan's case, selling properties, or, before you speak to Centrelink or before you get to 67. As always, we really appreciate the questions we get in the comments. And you'll notice that the podcast probably got a bit of a different look and feel for the last couple of episodes. We've brought on a new podcast editor, and hopefully things are looking a bit sharper now, as it's become evident that Scott and I are great financial planners, terrible podcast editors. Hopefully things are looking a bit better, but hit us in the comments with any questions or anything else you'd like us to cover in detail for you. You'll see Dan again next week. Scott will still be away, so we'll be back next week. Dan, anything to add or wrap up on, mate?
Keep the comments coming. I love it. I love reading the comment section of these podcasts.
Yeah, it's always an entertaining ride. Yeah. All right, beautiful. Well, look, thanks very much, and thanks for tuning in for another week, and we'll be back next week with another one for you.
Thanks, Phil.
Cheers.